Well, where it is after 3 o'clock, let's begin our program. Thank you, everyone, for joining us today. It is our quarterly economic and market outlook presentation for our clients, and happy to have you joining us today. It is July 13th, and we are recording the program, so if you do choose to participate with questions, just be aware that we will be recording the program and putting it up on our website. You do have the opportunity to participate with questions during the program today, either by raising your hand, or there's a section for question Q&A at the top. You can submit a question during the presentation, and we will either have the opportunity to read your question or unmute your line to share your comments. So, and feel free to let us know either way you'd prefer. All right, with that, let's jump in, and but we'll start by introducing who's joining us. I'm Chris Boyd, founder and CEO of our company, Asset Management Resources, and hopefully I know many of you already, as this is intended for clients. But also joining me is Brian Regan. He is a CFA, and he is our Chief Investment Officer. So Brian will be giving much of the presentation today. Also in the background, I don't know if you all will see her or not, but Kathy Ingersoll is with us. She is our marketing coordinator, and not sure the right title for you, Kathy. It's related to marketing. Director, is that the
Marketing
right?
Director.
Director.
I answered anything, Chris.
Very good. So, and she will be fielding any questions that may come in, and will be helpful if anyone's having difficulties during the presentation. All right, so as far as an overview of our program today, we are going to start off with a little review of what happened in the prior quarter, how that might have impacted our portfolio decisions, and highlight some of the things that have happened. We'll certainly be talking about the environment with the coronavirus and other economic impacts, how things seem to be shaping up. Brian will certainly go through some outlook as far as the way he envisions things projecting in the future and how that's impacting both stock and our ETF mutual fund strategies. And then we'll summarize that with some of the takeaways of things that we are recognizing. We'll probably touch on what's happening in the world of politics briefly, as how that might also have some impact for our takeaways. Brian, I think what's next is I'm going to turn it over to you.
Thanks, Chris. Please excuse my silly looking headphones here. We decided that it's easier to hear me, and that's ultimately probably what's more important if I have a little microphone near my mouth. So as usual, we like to go ahead and review what happened in the previous quarter and talk about some of the moves that we've made and how it impacts things. So last quarter, we decided that the market was approximately at fair value, but volatility was moving the market quickly. We thought there was value in high yield. So we moved into high yield unsecured risk pretty significantly. We started with it a little bit in some of the more aggressive funds in Q1, moved it everywhere in Q2, and it's really paid off. It's performed well over the last quarter, ultimately taking less risk than a normal total equity allocation. In the equity portfolio, we really concentrated on healthcare and technology. For technology, we added a significant growth portion to the portfolios, namely the QQQs and the ETF and mutual fund portfolios, which to much fanfare has done exceptionally well. We were a little concerned about the European financial markets. I'm still a little concerned about the European financial markets. We've had some good headlines come out of there, but I haven't seen much in the way of action when it comes to issuing bonds to address the pandemic and fiscal concerns of all the European countries at the Eurozone level. So it's something that we're continuing to monitor. I mentioned that, during the portfolio, we were overweight technology and healthcare. while underweighting stocks generally in favor of high yield. It really seemed to work out for us. We moved into municipal bonds across all portfolios, both taxable and non-taxable, because there was a significant mispricing between municipal bonds and treasury securities. Again, really happy with the way that panned out. We've started to see some convergence on a fair value price. So, it's done about 2.5%, 3% in the quarter, which is pretty exceptional for a AA rated bond to have an annualized return, somewhere in the neighborhood of 10 to 12%.
And that may be a once in a lifetime kind of an occasion where we have the opportunity or reason to consider using municipal bonds, even inside of taxable, tax deferred IRA type accounts. But just the price mismatch was such an opportunity that Brian wanted to take advantage of it across all of our portfolios. As we look ahead, naturally, we have to recognize what's been happening in the world around us with coronavirus. And this is a particular picture of the currently active cases of infected people. And we do see that as much as we've started to see some tapering or some bending of the curve, it has begun to escalate again, as we're all probably aware by watching the news. And so it's not what we'd hoped for. However, markets seem to be taking it in stride. Part of the reason may be as we look at the next slide. And that has been that as much as the death count is substantial, it's on a different slide that I was thinking of, the death count has begun to taper from its highs, the daily death count. We are at about 135,000 people at this point across the country that have been lost to the coronavirus. So what will happen remains to be seen. It is, as we look at more recent data than this graph presents, it has started to tick up again on the death count as a lagging response to the number of cases of infected. And yet, markets don't seem to be responding adversely at this time. Whether that will be the case as we look ahead, I'll turn things over to Brian to offer some insights as to how he's viewing this particular concern.
So when it comes to developing a fair value estimate for the economy, it helps to take a look at the data and see how quickly the economy is recovering. We're fairly confident that we're falling off the lows, so we don't expect we expect that the worst is behind us. It's still not good. We're still in a very, very deep recession. But how you can see on the chart on the right, this is these are initial jobless claims. This is folks that are going to the unemployment line for the first time. We approached 7 million when this first started in March. And it's still significant at 1.5 million on the June 7th to June 13th reading, which is, much higher than the 200,000 plus that we were having before the pandemic started, or really we had shutdowns in the economy. But it's still breathtakingly high. So although things are getting better, they're still bad, I guess is the way to think about it. Now, that story is also playing out on the left-hand side on the chart there. The newest data is 18 million plus, which is better, but still there's significant people still receiving jobless benefits. Now, keep in mind, this is close to 1/7 of the working population in the United States. So this isn't a small number that we're talking about here. So we have some improvement, but I think this data suggests that we have a longer road to recovery than many might expect. Goldman Sachs's estimate for earnings in 2021 particularly jumped out at me, where they were expecting $170 a share on the S&P 500, which is significantly higher than any forecast I have baked in to my numbers. And many of you might think that my fair value number is high. So
before you go on, Brian, if I might, like to add just some color in the sense that I think on as much as we, can't really just accumulate all these numbers that are on the right side and say, oh, that's how many people are unemployed. It may also be somewhat understated a little bit because of those people who have been furloughed and who are not counted in the unemployment rate numbers. But this number, the 20 million or so, Brian, is it correct that this is the number of people that are currently receiving unemployment claims?
Yeah, there's one data point that just came out recently, so now it's about 18 million and change. But yes, that's the correct way to think about this. Yes.
Thanks.
So that is different from the unemployment rate, though.
Right.
Which is what I think you were getting at.
That was my point. Thank you.
So there's also reason to believe that we're having a V-shaped recovery. So the multicolor lines that are moving from left to right is the amount of U.S. gasoline supplied. You could see that in the previous 4 years, it was around a seasonally adjusted 9 to 10 million barrels per day. And we fell to 5.3 million barrels by April 24th. But it's pretty clear that this is a V shape that's forming here, maybe slowing down in pace, but a little bit of reason to be optimistic. Now, the next slide shows an even more aggressive V shape where we see retail sales have significantly bounced off the bottom. So what do I think ultimately? I think that you have to take into account that certain parts of the economy are recovering, and but there's also a reason to believe that this rapid recovery is going to taper off a little bit before we get to full normal. So when it comes to stocks, are they overvalued? If you follow our webinars, you know that we show this chart every single time. I think it is it's a good chart to get a baseline of and actively follow. And as you can see, we're very, very, very expensive based on a forward PE ratio. This is from JP Morgan. It assumes about $140 in earnings in the S&P 500 over the next 12 months. That doesn't quite get us back to where we were in earnings in 2019, but it's not too far off. So it suggests a pretty good recovery. But it still suggests that the market's very expensive. Now, on a absolute basis, I agree that the market's expensive, but I circled that one number in the blue circle there. And what does that suggest? That suggests that the market's still relatively cheap versus other investment grade bonds. So it shows a difference between the earnings yield and the spread on a triple B bond. You're still getting paid about 1% more. So this is why, part of the reason why the market has rallied so significantly so quickly. Now, every quarter, we also do an expectation of where we think fair value is in the market. So my fair value range was about 600 points different for the S&P 500 last quarter. We've reined it into about 400 points this quarter. Generally, what do I mean by fair value? It means that if the market's within that range, there's a kind of an error estimate that we bake in to say, look, this is where we think it should be based on expected return, a weighted probability of recovery, and it's reasonable to pay this price for the market. Anything above that, we might be willing to sit on new cash, invest it in bonds, put together some kind of plan to invest it over time, or wait for earnings to catch up with the market. So for our fair value estimate here, we see that the V-shape, I put together 3 different kinds of scenarios for a V-shaped, U-shaped, and L-shaped recovery. I'm not committed to sticking to one, but it seems like the market is certainly pricing in a U-shaped recovery as of today. So the market today traded above 3,200. My U-shaped recovery is between 3,000 and 3,500. So it falls within that range. And my weighted average, I expect I put a 10% 10% chance of a V-shaped recovery, a 50% chance of a U-shaped recovery, and a 40% chance of an L-shaped recovery. And those estimates are largely based upon what we're seeing for the data, similar to the types of data and the representations that I showed a couple slides earlier. I put a 50% on a U-shape because that's clearly what the market's pricing in right now. So, that suggests that we're slightly overvalued right now since we crossed 3,200 today. Now, we had a nice question from a client, and I think it's a good one for everybody, and I'll just read it for all of you. Given that the markets have largely returned from their troughs in March, and in the case of tech, exceeded it and are reaching all-time highs, how should investors be thinking about de-risking realized gains or possibly planning for dips if certain states/parts of the economy need to return to some form of closure? So this is true.
This is probably on a lot of people's minds, so I think this is a great question for us to address.
Yeah, I agree. I agree with some parts of the question, and I disagree with the premise of another part. So it's true that the market's slightly overvalued, but I would say it's only slightly overvalued. And it is also true that in the case of tech, it's exceeding all-time highs. And I do think that there's two markets here that we need to be cognizant of. There's a market that might be overvalued and getting a little bit irrationally exuberant, but there's also a market that's clearly going to recover when we have some kind of recovery from a vaccine standpoint. And you can really see that in this chart. So the top charts, the NASDAQ 100, it's returned 17% year to date when I pulled this, which was a couple of days ago. It's actually even better than that today. And the Dow Jones Industrial Average, which was down 10%. There's really a tale of two stock markets, right? The QQQ is largely a technology index. It's highly concentrated in some of the names that have really run, right? So your Apples, your Amazons, your Teslas, your Nvidias, some of the names that have really stood out as high flyers are in that index. And that was partly expected that we would have a significant recovery in those names because interest rates were really low. But I would say it's getting a little bit out of control in some places, and it's something that we need to monitor. And it's part of the reason why we are going to scale back our allocation to the QQQ in all the portfolios and reallocate it to a lower volatility fund. Now, Dow Jones Industrial Average, if you were committed to this one, people would be a little bit upset with their returns right now. But, this is energy, materials, banks. There's some tech in there. Apple is represented in the Dow Jones Industrial Average. Airlines, Boeing's in there. It obviously hasn't recovered to the same degree as the QQQ, but that doesn't mean it's going to be like that forever. There's some good companies in here. And if you're willing to find the good ones and invest in them, then, hey, you're going to recover over the long term. And I think if this is something that, you're interested in, maybe our individual stock portfolio might be more for you, because the way we're doing it now is we own individual stocks that are part of the QQQ, but we only own the ones that are where the valuation makes sense, or we only own an allocation that makes sense.
I would also just, Brian, sorry, were you done making your point about the stock strategy?
No, sorry.
Continue your point, sorry.
And if we also own stocks in the Dow Jones Industrial Average that we expect to recover with time. We had another great question from the same individual who asked.
Before we go on to another question, that's where I would just like to add one point. I think the prior question about de-risking and realizing some gains and choosing which parts of the economy to prioritize is a great opportunity to highlight the active allocation process that we utilize each quarter, where there are revisions happening within the portfolio, to your point about de-risking, de-emphasis on some of the kinds of names in the QQQ, and maybe altering some of our emphasis to lower volatility stocks, maybe some positions that have less high multiple, perhaps some of the names that you might identify in the Dow Jones Industrial Average as an example. That as an active process that we undertake each quarter anyway for all of our strategies. And to your point, it can be even more opportunistic perhaps within the individual stock selections.
Yeah.
Okay, thanks. Yeah.
So I just wanted to address a question, Chris, but that was a great point. If someone had new money for the market with a horizon of 2 to 3 years before needing to access this money, are there sectors that look particularly appealing, or is everything too overvalued? I think the first point that we want to make is if you don't have a horizon of at least 2 to 3 years, we don't think it's a great idea to be investing in stocks. Really, generally, period. You need at least that kind of time horizon for stocks. Now, we just started talking about how there's one part of the market that's really significantly risen to the point where it could be considered overvalued, but then there's this other side of the market where we think there could be some value with a long enough time horizon, and that might be the place where you might be more interested in investing. And if that's the case, I do think we're taking advantage of that, like Chris said, in the active allocation, and you can even, I think, try to take advantage of it even more in the individual stock portfolio.
Okay, thanks.
So to that same point, I think that we were making on the last slide, where there's some parts of the market that may be overvalued and some parts of the market that may be wildly undervalued. I do think that we've seen a rapid rise in speculation and gambling in the market. So I wanted to pull out two examples of one of speculation and one of gambling, and just as a cautionary tale of warning for folks. So the top one is about speculation. I think Tesla is a great company. I think 20 years from now, Tesla's still going to be around. But Tesla has risen 500+% year to date. For many years, it lingered around $200 to $300 in a straight line. And then in the Q4 of last year, it decided that, hey, we're going to go up to $1,700 now. It's a rise that doesn't necessarily make tons of financial sense. They did generate $1 plus in earnings in the last quarter after many quarters of loss. But that means, let's say they're making $4 or $5 a share. You're paying $1,700 for $4 or $5 worth of earnings, and that's if they are able to continue to generate the earnings during a deep recession for a luxury product, which is questionable. And again, I think Tesla is a wonderful company, and my point that I want to get across to folks is that price matters. So on the right-hand side of the chart, right next to Tesla, I put Intel in here, and there's a million of these throughout history that I could, talk to you individually about if you're at all interested. But in 2000, Intel reached about a $60 to $67 price share. Today, it trades around $59.54. In 20 years, it hasn't reached its average. It hasn't reached a new high. And this is a company that's also been an exceptional company for the last 20 years. But in 99, 2000, people were just paid too much for it, and they paid for it dearly, ultimately. 20 years and not getting back to your high is a lot of money left on the table. Now, the other example, which personally gets me going, is Hertz. So Hertz is a bankrupt company. Their bonds trade at less than par value, which objectively means that their stock's worth zero. And it rallied from a low of 70 cents to $5+ in the matter of a couple of weeks. And people were trying to buy this up. Now, this is the ultimate example of gambling to me. And it was about, who was holding, who was left out on the final musical chair when everybody sold out. Now, the market's generally corrected it back, and it's still down 75% for the year. But ultimately, the stock's worth zero. And I don't understand why there's been some wild action in some of these stocks lately. There's been a lot of irrationality in the market. And part of it is because of low interest rates and, people looking for a way to gamble when they can't go to Vegas is partly what I think it is. But another cautionary tale, there's this company back in the early 90s, early 2000s called CMGI. Gillette Stadium was actually called CMGI Stadium at first, if anybody remembers. And that's the reason why I like to bring up this stock. it went from 0 to 140 in a matter of what seemed like minutes, and it was the darling of the stock market. And then just as quickly as it went up, it fell to 0. This company didn't make any money. It was the kind of the ultimate .com darling, and this was gambling too. People thought they were sitting on 140 times their investment in gains, and they ended up losing it all. So don't get excited about the hot stock of the moment. In my investor letter this quarter, I talk about how all investors have biases, and the key is to know your bias. And my bias is towards profit. So ultimately, I've promised myself, and I've said it to many people, that I will never get caught up in a 1999-2000 type event. I can see it happening to some degree today, and I'm going to be doing my best to, keep a disciplined, realistic portfolio. The other thing I wanted to mention was I wanted to talk about our gold holding. If you're an active participant in looking at your gold, your positions in your portfolio, you'll notice that gold has risen in both in value, which is a good thing, but also as a percentage of your overall portfolio over the last year. And I thought this was a great chart. It might be a little bit difficult to understand, but it's ultimately the reason why we've decided to get aggressive in gold starting back about a year ago. Generally speaking, when all the interest rates of the domestic developed countries move towards convergence, there's no clear place to go. And when that happens historically, people move to precious metals like gold. And since they've all converged on the zero lower bound, this is exactly what we've been seeing over the last year. And I thought this was going to happen a little bit more slowly, but with the pandemic crisis, this has happened very, very aggressively. And so we're in a good position to continue with our gold holding, and we're going to keep doing it until we start seeing interest rate divergence in developed countries.
Well, one of the other factors that is on people's mind as we go into the second half of the year and look toward November is politics. And of course, politics is a difficult topic to discuss. We don't try to approach it from a position of bias of who would we like to see, what's our outcome desire. It's not really relevant. What we're trying to look at here is what can we discern as to how it might impact your portfolio, different outcomes. And so we're giving thought to how things may project. This particular firm that we're getting this data from is weighing polling data, and it's really pointing to the fact that there's really a handful of states that are swing states, and as they go, to some extent, will define the presidential election. And as much as right now polling seems to favor one side over another, I think between now and election day, things are really more likely to get a lot tighter. And so we'll see how that plays out. The other factor that we have to pay a lot of attention to is what's likely to happen in the House and the Senate and in the Congress. It does seem probable at this point that the House will remain in the hands of the Democrats. It is uncertain as to what will happen with the Senate. And so one possibility is the idea that you could have an even split of the Republican and Democrat seats in the Senate. And so who wins the White House becomes all the more relevant for how the legislature would work as well, because the vice president, of course, is the president of the Senate and casts a deciding vote in case of a tie. So at this point, it's by no means determined as to what to expect. And of course, as we know from the prior presidential election, polling data is only as is limited in what it provides. It's not always as insightful as we might expect. But right now, it's kind of a toss-up. And so we're watching to think in terms of for whichever outcome we might entertain seeing how this plays out, what are the impacts, what are the emphasis, how might it play out in terms of which sectors could be benefited. Brian, you've talked about the healthcare sector as something that we've been invested in and have an emphasis on because it's relatively attractive in price right now. And maybe you want to comment about this as well, that it seems to be held back in part because of what may or may not happen when it comes to the election.
Yeah, I mean, I think it's been that way for probably since the market started pricing in that the Democrats would win the House of Representatives 2 years ago. And I think healthcare has fundamentally stayed lower for a lot of pharmaceutical companies in particular, and insurance companies like United Health and Pfizer come to mind. And I think the reason being is because there's concern about legislation that will impact those sectors. I think in general, politics in the longer run for stocks means less than what people typically think, is what we've seen in the data. But it definitely can play a role in the immediate impact, immediate aftermath of an election based on how things shake out.
I think it's really important too for investors to keep in mind that, it can be very hazardous to your portfolio's performance to overthink or overreact to what may or may not happen when it comes to politics. To your last point, Brian, you can point to different elections and say either side getting elected and markets responding favorably or unfavorably at different moments in time. I think it's a fair point that we might expect some volatility with potentially either outcome. And it's worth talking about the idea that our portfolio designs, the way we manage your portfolios for our discretionary account holders, we do some active adjustments to the portfolio, which is why we're paying attention to it. And as it stands right now, whether it's regarding politics or other concerns, coronavirus or whatever it might be, we are positioned in a way, largely because of valuation, in a way that is modestly understated for risk. We're a little bit defensive in our positioning, and we have the opportunity to turn up the risk dial a little bit or turn down the risk dial a little bit, and we will be paying attention to this among other considerations. So it's very much a case where you don't necessarily have to make radical changes in the way you think about your portfolio because of political concerns or other types of concerns, because as long as you have the right risk temperament conveyed to us, we're making some of those adjustments on your behalf within your portfolio. Feel free to add any additional comment, Brian.
I think that's a great point. Often people say, what should I do because of X, Y, and Z? And they just don't know that it's already done. We've already taken care of it. For example, last quarter, we were fairly confident that technology sector was going to run. You didn't have to tell us to invest in the technology sector before. We recognized that well. So, outperform bonds definitely. So we made that change. So you didn't have to. We recognized that high yield bonds were priced very attractively relative to equities. So, we went ahead and made that risk adjusted a change ahead of time. And we think, the value we add is doing all that research and monitoring of the capital markets, so you don't have to.
So I guess for those who don't have our discretionary services, those are the clients who may want to have more engagement to discuss some of these possibilities for changes that may be warranted.
So we want to talk about the takeaways like we always do. The COVID cases are rising in the United States. The death rate currently remains low. That could be subject to change, as we know there's a lag. There's evidence that the economy's bottomed, which I believe is the case, but it could be a longer recovery than expected. Most importantly, we think stocks are expensive by a conventional forward price to earnings ratio, but they're a fair value when you're considering interest rates and earnings yield. We think the NASDAQ making new highs while the Dow Industrials continues to linger is an opportunity to take some gains in the NASDAQ and reallocate it to lower volatility assets. We're very concerned about the speculation and gambling that's entered the market. If you are somebody who wants to speculate and gamble, we're going to try to strongly discourage you from doing that when you call us to try to do something like that. And some people maybe on the phone right now know exactly what I'm talking about. Given the global monetary policy, we're making a significant allocation to gold, maybe more than the typical advisor would. It's done very well for us, and I think we have a plan on when we'd like to exit that. And it doesn't look like anything on the horizon would make me change my mind on that right now. So here's a summary of the major changes that you'll be seeing in your portfolio as we do some trading over the next week or so. We're swapping out our bank loan fund for a different bank loan fund, just because we think this one has a better track record of risk reward returns. The one we were in was a Fidelity fund. It's done well, relative to the benchmark, but they did change their strategy slightly from what we understood it to be. So we'd like to be in a fund where we're more comfortable with the long-term track record of the stated strategy. We're decreasing beta by approximately 10% across strategies by adding USMV and reducing QQQ. Beta is a measure of risk versus the S&P 500. So if we decrease it, effectively, we're decreasing the risk in the portfolio. We're increasing the overall stock exposure by remaining underweight by approximately 10%. So what do I mean by that? Well, if you were in a 50-50 portfolio and you had 41% stock last quarter, you might have 45% stock this quarter. So you're still underweight, but we moved it up about 10%. Our duration is increasing by virtue of swapping short-term bonds for additional stock exposure, creating a natural ballast to increasing stock exposure. So the Fed has come out and told us very specifically that they expect to keep bonds low for the foreseeable future. And I am taking them at their word, and I'm going to take the increased yield on the longer end of the yield curve. And if the stock market sells off, these bonds should do better, at least historically, than short-term bonds, and we'll have a natural ballast to the increase in risk in the stock exposure. If you're in the dividend portfolio, we are eliminating FDL for a dividend growth strategy for similar reasons to why we're swapping out FRAX for CFRAX. It just has a better long-term performance, and especially how it performed throughout the cycle, the pandemic cycle, really. We thought this dividend growth fund performed better than the first trust fund that we were
on the sector exposure and all that.
Yeah.
Hey, one other thing you might talk about as are we at the point where we're just about ready for questions?
Yes, sir.
So I'll finish this point and I'll wait on my.
Yeah, so I think this is interesting. So if you're in an ETF mutual fund strategy, you might not see the specific names that are in your portfolio. So you could do a stock intersection report that looks through to the ETFs that you have and says what allocation you have to the individual stocks. So on the left is a typical 50-50 portfolio that we have right now for the individual stocks. You'll see that Microsoft's about 2%, Apple's 1.75%, Amazon's 1.5%. And on the right side, with the elimination of QQQ, well, not necessarily elimination in some portfolios, but the reduction of QQQ, Microsoft goes to 1.5%, Apple goes to 1.22%, Amazon goes to 1.03%. So about a 25 to 30% reduction across those names. And then if you look towards the bottom of the charts on the left-hand side, you'll see Netflix and Tesla and PayPal. They're eliminated on the right side. So not that these are the only stocks in these strategies, but these are some of the larger exposures. Ready for questions, Chris?
Yeah, I think just want to encourage people, if they would like to ask a question, now's a good time. They can either raise their hand if they'd like to have their line unmuted, or they can put in a Q&A, a question in the Q&A section, and Kathy will let us know. While we're giving a moment for that, a couple of things. One is, in addition to doing our quarterly economic and market outlook webinar that we just have gone through, we also are beginning a series where we're trying to do each quarter a financial planning oriented topic and webinar. We did one last quarter. It is on our client section of the website if you'd like to review that. But in addition, we have a planned event coming up for a webinar on September 16th at 10 a.m. You may want to mark your calendar if you'd like to participate in the live version. And we're going to have as a special guest Susan Turnbull, and she will be talking about legacy planning. Not only talking about legacy in the form of the things that we leave to our loved ones, but also the values and stories and life lessons that we may want to pass along as well. So one other thing, Brian, I think as we kind of wait for a question or two, if anyone has them, I thought it might be worth just reiterating or kind of focusing on the idea of balancing the current coronavirus case escalation concerns and the prospects of a potential treatment or vaccine, and how these are potentially very different impacts on the market. And just to kind of reiterate this notion of, one, how we're dealing with that, and two, just, you know, kind of restate your views. I know you've kind of touched on this already, but I think it's worth repeating in case anyone has any questions while we're waiting for them to voice those.
Yeah, so stocks are ultimately long-term assets. So what does that mean? It doesn't mean 3 months. It doesn't mean 6 months. It ultimately probably means 3 to 5 years. You know, if you look at a regression chart where it says, does value really matter? It doesn't really matter until 3 or 5 years. So it takes a while to play out. So what we've seen recently in the market is a strong, maybe overreaction in two separate ways. And I think this chart really shows it, right? So the QQQ, that's going to have your stay-at-home stocks that are often talked about, right? Your Zooms, your Datadogs, your you know, Teladoc type names that don't necessarily have a lot of profit in them, but certainly are being used more in the as we're all staying at home more here.
Okay.
Kathy, it sounds like you have some feedback there. And then, you know, when we have a vaccine, which is going to happen, and it's going to start getting priced into the market sooner rather than later, I think you would expect these two charts to actually flip a little bit, where you start seeing those nonprofit stocks that are doing well because they're picking up users sell off some, and some of these names that are pretty exceptional brands and franchises might start doing well as the economies can safely open up.
We do have a question in, if we're ready for it.
Go right ahead.
Okay, this comes in from David Dow, and David's asking, given the increased state, local expenditures to address COVID-19, to address the COVID-19 pandemic and diminishing revenues from closed businesses, how will the market address this increased debt at the grassroots level?
Well, what happens is it's being monetized by the federal government, right? So I think, you know, when I was first hearing the question, it sounds like it might be referring to muni debt, especially because the states are spending more money and they're having less revenue. Well, the Federal Reserve is essentially backstop all muni debt, so they're going to be able to refinance their debt for the next couple of years if they have anything coming due. So when they do have to address their debt picture, it's going to be multiple years down the road and not necessarily anytime soon.
So the bottom line is municipalities do have an opportunity to continue to extend debt, you know, add to their debts. without a concern of the well running dry, so to speak, in the near term.
Right. And we've only really seen this. I know this was an issue in the New York subway where they needed to refinance and they were able to do so. The interest rate's definitely higher, but I wouldn't call it onerous. But there is a Fed backstop. Now, I think people will get worried about general increases in debt overall. Well, it's going to get addressed in one of two ways or a combination of both. So what we have been doing and what I expect the United States to continue to do is we're going to monetize the debt. And that's fine to do as long as the creation of new money is offset by a decrease in credit. Otherwise, you'll get inflation. So everybody expected inflation when we had the first round of QE, but the reality is the destruction of credit was such that the increase in new money was perfectly acceptable in the marketplace, and we didn't have any increases in inflation. If we have any increases, if the other lever that could be pulled is that we could increase taxes. I think that's highly unlikely given the tenuous situation in the economy right now.
So just to be more clear as to the highly unlikely comment, you mean that in the very near term? I think.
Yeah, I mean, until we have a recovery.
Until the economic recovery is underway.
Yeah.
Yeah.
Which I would
ultimately, it's probably more likely that one, our current tax rate is scheduled to rise in a few years, 2026. So we know tax will increase. There's very possibly the appetite because of the amount of spending where this is on a federal level, we may see increased taxation before that. But again, some of that depends on how the election plays out to some extent.
I think a lot of people have the false impression that the government works like me and you with our mortgage, right? We have a mortgage and we need to generate income and we need to pay it. Otherwise, we're going to get defaulted on our home and we're going to lose Alaska or something. That's not going to happen. Just, simply stated, the United States is a reserve currency of the world. I think it's over 70% of all transactions in the world are done with the dollar. It's a necessary currency, and people will continue to finance our deficits until proven otherwise, as far as I'm concerned. And when that doesn't happen, that's the only time where you need to be concerned about raising taxes. And there's been no evidence whatsoever of that.
So not an immediate concern is kind of the answer.
Yeah. In the meantime, I would expect this trend to continue because they are really.
And with regard to the municipalities, Brian, it is a two-edged sword, so to speak, with the notion that not only are there increased needs related to coronavirus and the pandemic, but there are decreased revenues also, for similar reasons. Same answer at this point on the state level and municipal level, not as great a concern in the near term.
Well, I think there's a difference between whether they're going to be able to pay their bonds and whether the states are going to be in good shape. I think you're going to see rapid cuts to the state budgets, but that doesn't mean they're not going to pay their bonds. They're going to be able to pay their bonds. They have to. It's a constitutional law.
Yeah, and again, there may be tax increases to deal with this as well. One way or the other, they're going to try to deal with some of these issues.
That's a good point because that's one of the things that you could expect to extend the recession, right? It's because after the financial crisis, not until a couple of years later did we see massive cuts to public services. And when we started seeing massive cuts to public services, we started to realize that the recession was going to drag on a little bit longer than previously hoped. And I do think that's going to be, it's going to be the case here too. Public entities report financials at best a year in arrears, unlike corporations that do it quarterly. So sometimes there's no pressure to do it until it's very obvious when they're reporting in their financial statements.
But to address the point that David was asking, does this have any consequence? We have mentioned earlier that we have a municipal bond position throughout many of our client accounts. And of course, in David's case, we have some additional municipals throughout his account. Should this have any impact on decisions for people who are invested in municipal bonds as a heightened concern?
Well, we saw a sell-off initially when these concerns were at the forefront, but now as the market's kind of realizing that this should not be a concern because people will be able to roll their paper, the price mismatch is coming back into line, as we mentioned earlier. So I don't expect it to be an issue now.
Okay, great question, David. Thank you for submitting that. Kathy, do we have any other questions?
We do. We've got a couple others here, Chris. One person is asking how international trade has changed as a result of the pandemic and what effect that has on international investments for the short or for the near and long term.
Thank you.
That's a great question. I don't have any specific data to share with you right now on international trade, but I could tell you that business investment, because that data is usually 3 months in arrears, so it's not very helpful right now. But what I can tell you is that the emerging markets have done exceptionally well. China, for example, their stock market has seen a 5-year high as of late. And part of that is because they were able to handle the pandemic very, very well. And they're starting to grow again. So I think they just reported a 2% GDP growth, which is very low for China, but considering the circumstances, you can't dislike it. Now, that's part of the reason, the emerging markets picked roughly 50 to 60% of all basic materials and oil is sucked up from China and the surrounding emerging markets. And that's why we've seen oil rally back from negative $37 on the 1-month contract to $44 when I last looked. So generally speaking, the emerging markets look good. On the developed markets, particularly Europe, I still have concerns about the stability of the Eurozone, which, we're generally out of Europe-specific investments, but we are in a fund that actively manages and looks for opportunities within Europe. And we're also in Great Britain because Great Britain has left the euro. So they left the Eurozone. They were never on the euro. And they have their own central bank. So the trade deals are being negotiated by one basically totalitarian conservative government. So we have less concerns there. So we're invested there as well. I will gladly share trade data when there's more reliable trade data to share. But right now I don't think we have much to go on.
With respect to that, we continue to be underweight international exposure. It's also worth pointing out, despite the recent good news that Brian was talking about with emerging markets, on the whole, we're underweight emerging market exposure because this is more volatile, though over time we would expect to have more exposure in this area because of the demographic opportunities it represents long term.
Right. If you're in an 85-15, you have more exposure as a general rule because it's a more aggressive portfolio.
And with that in mind, just real quickly, Brian, sectors, some of our clients may be in a more sector rotation strategy. Anything of note to highlight as part of that?
Well, we've got really nothing but good news coming out of there. So we have what we call a momentum strategy, and we have a fundamental strategy in there. For the fundamentals, we've been in semiconductors, which have just been on a tear, and energy, which has really recovered well from the bottom, as I just mentioned. And with the momentum, we've been in medical devices, which has obviously done well. Gold miners, we got this gold holding slide up here. They've obviously benefited from that. Copper prices as well, since gold miners usually mine copper as well. They've also done exceptionally well. Cloud computing, just been on fire. And
So good news generally.
and cybersecurity. So we're not making any changes because the sectors that we're in continue to do well. We are increasing our small cap a little bit in that portfolio and the 85-15 because historically speaking, small cap value leads out of recessions. So this might be a timing issue, right? It might not perform great over the next quarter, but it could. It might not do great over the next 6 months, but it could. And, when it comes to 6 months to a year, I'm fairly confident it's going to lead out. We use a blended small cap fund because rather than a small cap value, because with these exceptionally low interest rates, growth has been leading the way. So what we're doing is we're hedging our bets. We're saying, hey, historically large small cap value has led out, but this is a growth environment. Let's take a little bit of both and use a fund that uses both.
Kathy, another question?
There was just someone who's asking for comments about manufacturing and, they're challenged automobile manufacturing who have spent money on inventory and they're not producing sales. What do we see for the mid to long-term future there?
It's a good question. In the individual stock portfolio, we owned Ford and going into the pandemic because it was priced very attractively relative to their earnings. But what you need to know about a company like Ford is they're not just a car manufacturer and but they're also a bank because they finance a lot of the inventory to their dealership. When they lost their their investment grade rating and fell to high yield, it becomes very difficult to continue to finance those vehicles, which was something I was concerned with, and we got out of the sector for that reason. Then there comes that airplane manufacturing, aviation, which is a big industry in the United States. With Boeing, Raytheon Technologies are two to come. Lockheed Martin are three that come to mind. Raytheon Technologies is working. Their airplane maintenance business is working at about 30% capacity right now. Not exactly ideal. Boeing struggles with the 737 MAX. And now losing orders because of their customers nearing bankruptcy. Obviously, not great news. But these are great examples, I think, of possible recovery stories when we get a vaccine. And if they're well capitalized, they can be opportunities there. Historically speaking, I don't know why, but on CNBC, there's people who just always love Caterpillar or 3M. I've never understood it. The financials don't really sell me on the story. So, there's some out there that some people just love to own because of branding, I would guess. So it's a mixed bag. Honeywell is a European company, so that's one that gets thrown around a lot. I think it's an exceptional company. They make great products, but I expect I want European stocks at a significantly lower valuation than United States right now. So those are things that you can consider. General Electric has boatloads of problems. They still have long-term care insurance issues. They have pension issues. Lockheed Martin has a pretty big pension issue, but they've performed exceptionally well for many, many years. So there's some stocks in here that could be opportunities, and there's some that have longer-term concerns. And if you want to get into that sector specifically, if you want to pick and choose the best manufacturing companies, I really think it's better to do it with an individual stock portfolio rather than with ETFs and mutual funds, because there's some dogs with too much debt, and there's some that are just going to thrive when we get through the other side.
Great.
So Kathy, would you just make note of who that question came from, and perhaps we can reach out as a follow-up to see if there's some additional questioning we should address.
Absolutely.
Are there any other questions at this time?
I don't see any that have come in through our chat.
Okay, very good. Brian, maybe just bring that to the second to last page there, and we can remind everyone again, do check out our, make note of the date. You may want to join us for that webinar. If you didn't catch the entirety of this webinar, we will be posting it on our client page for our clients to review at their convenience. Thank you, everyone. I hope this is of help. If you have any questions, whether it's regarding your portfolio or the broader context of your financial planning, we're here to help. So reach out, let us know. We're happy to meet with you. We're trying to do most of our meetings at this time through virtual meetings. But if it's necessary, we can meet in person. Brian, any parting comments?
Exciting time to be an investor. You know, there's a lot of dynamics going on. There's some great value in some places, and there's some extreme, you know, speculation, overvaluation, irrational exuberance in some places. And, you know, I'm happy to field all your questions and explain to you exactly what we're trying to do. You know, our job ultimately is to avoid potholes and get you to where you want to go. So, you know, please don't hesitate to reach out if you have any questions, especially when it comes to quarter end and we start to think about making changes.
All right, very good. Thanks, everybody. And let's just put up our disclosure, sort of the final slide, and we will conclude our event. Thanks for being with us, and do let us know if we can be of any help.